Welcome to the second of two videos of Chapter 8, and we're going to finish off the special cases for using the contribution margin in short-term decision making. So if you remember from last time, we looked at special orders and that sort of thing, and we have three more things that we're going to look at here, three more special cases. And they're what happens if you have a resource constraint? What happens if you've got a choice of either making something or outsourcing it? Or should you keep a product as is, or will you make more money if you upgrade it or improve the product? And just remember, this chapter is based upon a couple of important things. First of all, we're using contribution margin to make our decision. And the information that we're using as part of our framework, as part of our model, is the relevant information. And let's remind ourselves that the relevant information is that information that is different between scenarios. Whenever we're making a decision, remember that we first want to identify what are the 2 or 3 or more scenarios that are possible outcomes. And then let's look at the information that's different. Any information that's the same between the scenarios we would consider not relevant for our decision making and not include it. Not to say that it wouldn't be included in our financials and all that stuff, but as far as the decision making framework, we're going to focus on the relevant information. Okay. So let's take a look at this first thing here. Now, in a resource constraint situation, we first want to, let's take a look at some of the information given. Essentially, we're told that we have a certain amount of display space on which we put a bunch of different types of drinks, and we want to know which combination of drinks, cola, bottled water, and orange juice, is going to give us the most money. Well, the idea here is the reason why it's constraint. There's a constraint is A, that there's only a certain amount of display space, right? But B, perhaps there's more demand than we can put out product, right? So if we have to say, okay, we could probably sell everything we want, but what combination of things is going to give us the most amount of money? So we have all this information. So we have, this is how much linear space it is. Now notice here that cans, you can get 5 to the linear foot, and you can get 3 bottles to the linear foot. Here you have the retail price. Here you have the variable cost, and you have a few other bits of information. So what is the resource constraint, and how should we stock the shelves? Well, this is the important thing with talking about a resource constraint. First, you want to identify the constraint. The constraint is amount of dollars or demand or anything. It is linear feet. We only have a certain amount of linear feet. And so we need to figure out how to stock these shelves. And so therefore we're going to say, okay, if that's the constraint, if that's the item constraint, what is how are we going to stock the shelves? According to what principle? Well, we're going to stock it according to what maximizes the contribution margin for every linear foot. So not what is the contribution margin per can, or what is the contribution margin per bottle. Because we've identified the constraint as being linear feet, we're going to recalculate these things as what is the contribution per linear foot. So let's take a look at it, see how that's done. So I've pulled down a little bit of the information that we were given, and we want to figure out these contribution margins according to each individual unit. So here this would be, well, that's $1.20. Boy, it doesn't like dashes and dots. This is $1.30, and this is $1.35. If I just went according to the contribution margin of the individual item, cola would be the lowest, and water and OJ would be the highest. But because we're actually doing it by linear foot, we have to go back up and remind ourselves. For cans of cola, it is 5, and for bottles, it's 3. So we would say, okay, remember we're trying to figure out what's not the contribution margin per unit, but the contribution margin per linear foot. And that way, that helps us see the differences. I guess put the cans and the bottles on even footing. So we would say there's 5 per linear foot here and 3 for each of these. So here, this comes out to $6. This comes out to $3.90. And this comes out to $4.05. Under this scenario, we can see cola is number 1. OJ is number 2, and water is number 3. And that's not the order that we would have it in if we look just at the contribution margin unit. So the highest contribution margin per linear foot is going to be cola. So if we said, if we could sell all the water or all the OJ or all the cola that we wanted, we want, demand would buy everything, what would be the smartest thing? What would give us the maximum contribution margin? Well, we'd say just sell all cola. If you sold all cola, well, we have how many linear feet? We've got 110 linear feet. So we would say 110 linear feet times $6 would be our maximum that we could get, 660. Well, because of a lot of things, just remember these decision-making, I guess, models isn't all the information. There may be other reasons for doing things. And so, for example, we're given the idea from the problem, perhaps they want to, no matter the fact what would sell the most or represent the most money, they still want to provide a variety of products. And they've given us a stocking rule here. They said you can have no more than 60 feet for any one product, and you can have no less than 20 feet. Okay. So if we look at number 1, number 2, and number 3, well, we're going to probably have as much cola as we can have, as little water as we can, and then OJ would probably make up the middle part. So if we took this and said, okay, remember that we have 110 linear feet. If we said 60 feet for cola, that's the max we can put to anything. Water was our number 3 thing, so we want to put the least for water. So that's 60 plus 20, that's 80. That leaves 30 left over for our middle item. So remember our units per linear foot here are 5, 3, and 3. So if this is how many linear feet we stock, actually how many units of each thing. So this would be 300 cans of cola, this would be 60 bottles of water, and 90 bottles of orange juice. And if we said under this stocking rule, this is maximizing according to this rule, what would our contribution margin be? Well, this would be 360, this would be 78, and this would be 122 for a total of 560. So notice 560 and 660, our maximum we could get, irrespective of doing it, of trying to have variety, would be 660. If we have this stocking rule, we can still figure out a way to maximize it, even though it might be underneath the total maximum we could get. So this would be the contribution margin for this product mix, 560. Okay, moving on to the next one. We're going to look at a fairly common decision. You may be making something yourself, but that may not be your specialty. In other words, you may be a company that grew up designing one product and you decided, well, it'd just be easier to make this other thing, even though that's not your specialty, just to keep things in-house. Well, as time goes on, a lot of factories find out that it's easier to outsource small things that are not crucial, that's not their specialty in making. And so a lot of times either they'll solicit a bid or someone will come and offer, and that's what we're looking at here. This company is making something, and then another company comes in and says, we will offer you this thing that you make yourself. We will offer to sell it to you for $12.80 per foot. Well, you go, you listen to this offer and you go, well, how much does it cost us to make it? What's our internal cost? Well, initially, you look and you see it's $14.75, and this is kind of the breakdown of the $14.75. And you would say, oh wow, $12.80, it costs us internally $14.75. We would do that. Well, not so fast. Remember, whenever we're making a decision between two scenarios, we want to look at the relevant information and the relevant information only. So let's look at the other information and determine what is relevant and what is not relevant. So remember, our two scenarios are buy or not buy. So this third bullet point, no fixed costs will be eliminated if outsourced. So fixed costs, what are we going to decide? Does the fixed cost change? No, it says nothing will change if we outsource it or don't outsource it. So fixed costs are not relevant. Not relevant. Now, if we were to outsource it, well, we'd have some space freed up, right? We'd have some space on our factory floor. We're not making this item anymore. Maybe we get rid of some pieces of equipment, and we would say, well, we could do something else with that area. Maybe we could rent it out, or expand the production of something else. But in general, we find out that extra area that we freed up, we could generate 30,000. So this is relevant. So relating to the fixed cost, we would say, well, this thing is not actually relevant. So let's recalculate what are our relevant costs. Our relevant costs would be 1275. Because remember, in this scenario, it doesn't matter whether we outsource or don't, we're still going to have all that fixed cost. So we would therefore say, well, that's not a relevant piece of information. So now when we say 1280 versus 1275, we say, well, it costs, now we may change our mind and say, well, it cost us less than what we could buy it for. But remember, we have this extra piece of information. We've got this, yes, it would cost us a nickel more. It would cost us 5 cents more to buy it outside, but we would gain 30,000. Does that 30,000 overcome that extra nickel that we have to pay for each piece? Well, we have to kind of do the numbers, right? So what would the increase or decrease if it outsources? So if we look at these variable costs, and so I'm going to leave off all the zeros here. So this is 1275 times 100,000, right? So that would be 1.275 million. So I'm going to leave off these extra zeros. If we outsource, it's 1280 times 100,000. So that would be 1.28 million. And so the difference here is 5,000. In this particular scenario, we said fixed costs did not change, so there's nothing here. And so the totals would be just the same right here, 1275, 1280, and the difference would be 5. Now we do have this 30,000 of extra contribution margin. So there's no extra profit if we continue to make it, but if we outsource it, 30. So when we're doing this, you have to remember which direction these numbers are going. These are costs. In other words, this is reducing profit. So maybe we should just put these in parentheses, right? And this, now whether or not that works on the homework, I'm not sure, but I'm just trying to illustrate the fact that these are positive and negative numbers, right? We're saying that these are costs and this 30,000 is profit. So in other words, this profit is reducing the amount of cost. So if I said if I continue to make it myself, it would still be 1275 in costs. But we would reduce we would spend 1.28 million, but we would get back 30,000 so that the overall cost under under outsourcing would be 1.25. In other words, it wouldn't cost us as much. This would be less cost. And so the difference would be 25. And we would say operating income would go up by 25,000 because we reduced cost. We reduced cost by 25. Where do these come from? I do not know. Is there any more? Oh, there are. Okay. So there's another part of this, and it's actually kind of an interesting thing, but don't I guess it's fairly straightforward, even though it may seem a little complicated on the surface. So the question is, what would the company be? What is the maximum the company would be willing to pay for outsourcing? In other words, under this scenario, we would reduce our costs by 25,000 operating income. So what's the maximum we pay? Well, the maximum we would pay is where this essentially goes away, where what we buy it for essentially is what it would cost us internally. Now, the problem is that we have to take into account this 30,000 because that's something that's different between the scenarios. So it's not just the 175. So let's remind ourselves a couple of things. First of all, we're not going to consider the fixed costs because those aren't relevant. So our total manufacturing cost for the decision is 1275. So how would we go about this? In other words, they're offering at 1280, we gain 25,000, right? We're up 25,000. So what happens at 1290? How much would we get? What would happen at $13? Essentially, that's what we're trying to figure out. How much does the price have to go up before we eliminate this profit? So how we do that, it's a fairly simple, straightforward thing. We would say, we would say 1275 times the 100,000. We've already done that. That's the 1.275 million. And then we would add this extra, and that would give us 1305. And then if we divide that again by the 100,000 units, that would give us a number of 1305. At 1305, essentially what we're saying is this goes away. We neither gain nor lose. So if a company comes in, the maximum we would take from them is 1305. And even at 1305, we would say it's not really worth it maybe, or it could be, I don't know, but we neither gain nor lose any money at 1305. Anything less than 1305, we gain a little money. And we have a special name for this. We call this the indifference point. And essentially what it's saying is at this point, at 1305, we neither gain nor lose money. The company is indifferent. Below that, we want to do it. Above that, we don't want to do it. So it's not so much saying that, oh yeah, we're hoping for 1305. We're just trying to figure out 1305 as that's the tipping point. Below 1305 is good, above 1305 is bad. And therefore we call 1305 the indifference point. It's neither good nor bad. The last one is whether or not you should upgrade a product or keep it as is. So we've got another situation where we're making something in batches for 540 gallons. We sell this stuff. I forget what it is. It's yogurt, I believe. And we guess we sell industrial tubs of yogurt for gallon tubs for $8. And we have these variable costs. The decision is, we could make a little individual portions for people. But that would require, we'd still have to do all of this. And we'd have that cost structure. And we would have to do this additional amount of processing. So the idea is, do we make more contribution margin just doing this part? Or if we incur these extra costs, is the contribution margin after this, is it going to be plus or minus? So these are our two scenarios. Keeping our current production as is, or adding these extra costs, doing extra things, but for a chance of higher margin. So we would go ahead and, once again, make a bunch of calculations based upon the relevant information and looking at the contribution margin to decide whether or not it's worth it one way or the other. So here we've got revenue. This is 8 and this is $1.56. The packaging here is 16 cents. The packaging here is 7 cents. There's no additional cost for fruit here. The cost of adding the fruit to the yogurt is 10 cents. Now, what's the benefit? So remember, we're trying to figure out, this is sales minus costs. So this is kind of our contribution here. So this is going to be $7.84, and this is going to be $4.39. Now, obviously we're comparing two very different items. So what we're going to do is we're going to multiply them out. And I see that I didn't actually, I've uncovered the answer before. But because we're dealing with two very different amounts of items, we're going to multiply those out to figure out whether or not which one is going to give us the most contribution. So we'd multiply the 784 times all the gallons, and we multiply the 39 cents by the 11,520. And that's going to give us a benefit of, you can see right here. Now you can see doing the further processing to put it into individual portions, while we do take on additional costs, because the contribution margin, now you see, if I just told you the contribution margin for this one was 784 and this one was 39 cents, it's hard to tell. So we've got to look at it in the total amount of the total amount of things that we would sell. So here, if we sold everything we made in gallons, we would make a total of 4,234. If we end up reprocessing it further and selling it all as individual things, we would make a little bit more. Now that may not seem like a lot, but if this was in the millions, if this was 4,234,000, well, that would be another 260,000 more. Well, that's worthwhile. So anyway, that's the end of chapter 8. And just remember, all of these special cases may seem complicated, but it really comes down to identifying what are the 2 or more scenarios and identifying what the relevant information, and then calculating out the contribution margin, whether it's the individual or the total. It depends on the scenario, but we kind of use the same general approach to each one of these to make a decision. Okay, if you have any questions, please email me or visit me during the Zoom office hours. Thank you.